Hi folks, Chris Mathis here and welcome to our weekly FX brief. I am the Chief Currency Strategist here at Bank Pips Global. You can check us out at bankpips.com. Basically, our goal is to help retail traders transform their thinking and their business into what you would see at the institutional level. So we want you to think like an institutional trader. We want you to use the same tools as institutional traders. We want you to look at the scope of the market and step outside of the technical analysis box that dominates the retail space. On that note, let's talk about what's going on in the markets right now. Look at some of the risk events that are coming up this week so we know when to expect potential volatility. But it's important to note that traders right now are not really focused on the economic data. It does create some movement in the markets, but it's not creating sustained movement because the market is focused on what's happening with the broader picture right now. We know we've been dealing with the COVID-19 crisis. We know we've had equities continuing to rise, specifically U.S. equities that have punched to new all-time highs. If you're looking at the NASDAQ, you're looking at the S&P. And this has occurred while growth numbers have been absolutely horrendous globally, right? So the market has been focused on the broader picture, which is risk on, risk off. Are we seeing flows coming in on the risk side of the markets? Are we seeing flows come in on the safety side of the markets? And it's also been a very thin market. So we're into September now, which means liquidity is coming back. We're coming out of the thinnest traded month of the year, which is August. And towards the last week of August, volumes really declined. I mean, it was a very, very thin market. One of the currencies we were looking at has been the Australian dollar. And we saw the Aussie blow through some really key high time frame liquidity zones during the month of August and even before that. And we were looking at why wasn't the Aussie really responding to these areas of liquidity where we typically see a response. It doesn't mean the market has to turn, but we typically see a response. Just looking at what we call the liquidity ladder, it typically gets a response just from orders and different things that are happening at those levels. So when we looked at how thin the market really was, it gave us a better idea of why we were seeing it just kind of blow through those areas. But now things are changing. The tide is turning a little bit. Liquidity is coming back in. The equities markets have put in some really significant technical patterns that we'll take a look at here in a moment, which is suggesting that we could see a more significant sell-off coming in to the equities markets here in the very near future. So to start, to get us caught up, we saw growth data out of Japan today. It was adjusted a bit worse than that we saw for the preliminary data. It came in showing a contraction of 7.9%. Now that was still better than the consensus that was expecting a contraction of around 8.1%. Still very, terrible numbers when it comes to the fundamentals right now, but that's not what the market focus is. We saw NAB business confidence out of Australia come in at -8, an improvement, but still very bad at this point. Later on this week, we will get the Westpac consumer confidence. Consumer confidence and business confidence are things that we're looking at very, very closely because these are leading indicators about what's happening on the ground. Just like for the US, we're looking at the weekly employment data instead of really focusing on the NFP number, that monthly number, because things are changing so fast, they're so dynamic right now on the ground that we have to try to get a little bit of an edge about what's happening from a weekly perspective, for one. So we look at the jobs data on a week-to-week basis. And again, the consumer, understanding what's happening with the consumer and business confidence is very important to kind of forecast some of the macro numbers that could come out later on down the road. We get Chinese inflation data coming up this week. We also have the BOC and the ECB as far as central banks are concerned. We'll get US inflation data coming up. So we have quite a few things coming up this week that could provide some volatility, but we really want to focus on what's happening with the equities markets. And with that, I'm going to go ahead and switch over and open up a chart of the US markets right now. And I want to show you these significant technical reversals that we're seeing. I'm going to open up the Dow to start. Now on the Dow here, if you're familiar with gaps, we have a couple of kinds of gaps. We have acceleration gaps and ending gaps. Well, here we have what's called an ending gap. So we gapped higher and then we had a quick reversal that went through the gap and was actually what we call a double close key reversal, meaning that this close was below the previous two daily bars here. Okay, so we had an ending gap followed by a double close key reversal, and you can see we've continued to have some pressure even though we've pulled back here a little bit. Now this is the actual equity picture. We can take a look at equity futures as well. That way we can kind of see what's happening right now. And this is a real-time look at the equity futures, and you can see we're seeing weakness. You know, as we would anticipate, we're continuing to see some weakness here. You know, look at even the Nasdaq. And the Nasdaq, this is an impulsive decline. This is an impulsive decline. So we're looking at this as something more significant developing, which takes us to the currency side of things, where we're expecting some broad US dollar strength to come in. So let's go ahead and look at, I have the euro here because the euro has a nice little setup developing that we really like for a short opportunity here. Now in this situation, we're looking for a 50% discount on the euro US dollar. Here you can see a nice little divergence at the highs, price moving higher, RSI moving lower. We're getting a little bit of a correction now with the initial decline, and we're looking for a pullback into around a 50% discount or 50% retracement. Initial targets for this type of a setup would come in with the 127 extension, which at this case is 1.1720. So 11720, although we could very likely target the bottom of this cycle. And this is just a near-term look. So the near-term look around 117 looks to be pretty good, and this could be something much larger developing here at this point, considering what we're seeing happening on the equities, in the equities picture at the higher degree time frames. This could be just the beginning of something more significant. You guys know, if you've followed us for any kind of time, that we've been watching very closely what's happening with the economic side of things, with the bond side of things, with global flows, with what's happening with equities, what's driving equities, looking inside the equities picture, not just the indexes, but looking at what's really driving these equities markets. And we know it's been a select few big name currencies, a lot of amateur traders, millions and millions of amateur traders that have come in during the pandemic, during the quarantine. You know, a lot of sports bettors have come in. I mean, it's just been so many people that have, in the US, there's stories of the stimulus checks that were sent out being put into the equities markets. And a lot of these are long only accounts. So we've had this just continued push higher in equities, even while the economic situation, the growth numbers, you know, employment numbers have been absolutely horrendous. Of course, the other side of that is we've had a lot of liquidity pumped into the system by the Federal Reserve, the Fed, looking to avoid a repeat of what we saw back in 2007, 2008. They're trying to stop a financial crisis from developing from the economic crisis that we have. And of course, we see a significant risk of deflation. Now, we've heard a lot about inflation. We see a significant risk of deflation. When we look at the levels of debt, when we look at the levels of credit, we look how much money is in the system right now. These are all things that you need for a deflationary environment. So we have, I mean, just incredible amounts of credit, incredible amounts of debt, a lot of money out there in the system. Americans and people globally are saving money right now. They're saving, they're not spending, and that's where you start to get the risk of deflation, of a deflationary environment coming in. We already saw WTI oil drop to below minus $40 per barrel before snapping back. Now, one of the things we were looking at coming into this is something we've been anticipating for a while. We were looking at the commodities markets, we were looking at the equities markets, and commodities, specifically when we look at oil, we've seen ending diagonal patterns coming into significant levels. We had Brent close a gap with a diagonal. Let me actually open that instead of just talking about it here. So here is UK oil. Here is that Brent right up here at the top. And you see the diagonal cycle that came in. And we mentioned this, I believe, in our last video. This is a very bearish look. Okay, when we see a diagonal, you guys might know it as a wedge. Here, right at the close of this gap, and we're breaking down. So we were anticipating this breakdown at the last video we put out, I believe. And we're seeing that now. Okay, we're seeing that now. The entire cycle here is questionable of what this is, what this rise is. Is this a corrective rise? Is this the beginning of something potentially larger to the upside, maybe some kind of an ABC cycle? And time will tell with that. But right now, here in the immediate time, we look for a target back to the beginning of this cycle. That's our first target would be right here on the Brent market, about 37.19-ish, down there, or 37. We'll just say $37. Let's jump out of here. And we also had copper was something we're really focused on. Dr. Copper, this is a global commodity where folks look to this commodity as a gauge of what's happening with the global economy right now. And we came into a major level of resistance here. You can see this level right here. And what you see when you see this little, we have this is liquidity, essentially. This is called volume profile. And right where we reacted is called the point of control. This is the highest amount of activity during this entire sideways move up here where we saw the reversal. So we saw the market come up into it. We were expecting to get rejected here. With what we saw happening in oil and in copper, it was a good sign that we were ready to see something more significant coming. Then obviously we had that turn in the equities markets, and all of this should be US dollar positive, and that's what brings us to the idea of the short opportunities for the euro US dollar, as well as the Aussie dollar. Remember, the Aussie dollar has been a currency that has continued to rise. The Aussie's been one of the stronger during the recovery. It was also one of the ones hit hardest during the collapse, during the crash. Now here we see yield spreads, and yield spreads are something else that we use as institutional traders. We look at yield spreads it's a way we can quantify the fundamentals. Essentially, we look to the bonds market, look at yields. We know that currencies typically follow yields, but we had some things developing prior to what's happening now. Here you see yields, how they jumped when we had the crash, and then immediately afterwards, we just had this really strong surge. Now, a lot of this was thinner trading, but you can see that yields give us a really good idea that this decline wasn't sustainable. All right, and now what we're seeing is the market's continuing to push higher. Yields have flattened out. Okay, the spreads have flattened out. This is the spread between the Australian dollar and the US dollar. So now we're expecting to see this market pull back. Okay, this is just one of the tools that we use. We use multiple tools here, as you can see. We try to step outside the technical picture where we're looking at the economics behind everything. We're looking at what's happening with equities and the correlations and the intermarket aspect. We're looking at yield spreads. There's several other things that we look at as well. The idea is to get a complete picture of what's happening in the markets, which gives us a more significant edge. Now, let me actually go to the the Aussie US dollar chart. And here we see at the end of this cycle, we can already see during this rise, this final rise right here, we had a nice little divergence, an ending diagonal. We just talked about ending diagonals in oil, divergence here, and the sharper decline. This sharper decline, we look for the setback to sell. Now, right now, we didn't quite get our 50% discount on this. We came up as high as, 73.10 or so. But our target is down back at the lows. And you can already kind of see how we're set up here. We're looking for the market to pull back into our discount range. We have our stop loss above the high. This is where we want to be out of the market, because if it moves past this level, then obviously we're incorrect about what we see happening. Now, this doesn't have to happen where we could actually see this pull down and then pop up one more time to get that correction. Maybe this cycle isn't complete yet. But the point is, we're looking for that 50% discount to give us a good reward to risk ratio. And we have very specific stops and targets that we use. Okay, so bottom line, we are looking for some US dollar strength to come back into the markets with the equities markets decline. The US dollar is a safe haven currency. The dollar has weakened during the entire rise of the equities markets right now, and we think that's going to very likely change with the picture we're seeing in equities at this point. How long that lasts remains to be seen. We're just going to take this one step at a time, one cycle at a time, and go from there. So we do like the idea of shorting Aussie US dollar if we can get that 50% discount. Looking to target down around 71 for that. And the other one we like is the Euro US dollar here. Same deal. We've had the initial decline with the divergence. We're looking for a 50% discount, takes us back into a nice little resistance area as well. And we'll look to target down around 117 for this. 117.20 is the extension. However, 117 is the figure that's pretty close by, and we like that as well because we like targeting the bottom of the cycles. One of the primary targets that we look at for an ending diagonal is back to the beginning of the cycle. Now, you notice we didn't talk as much today about the economics behind everything because the economics are not as important right now as the intermarket aspect and what's happening, say, in the equities markets and the bonds markets. That's where we're really getting the picture that we want to see for trading at this point. It's also a reason we haven't really paid very much attention to things like the City Economic Surprise Index. One of the things we talked about last week, and I'm going to show this again. It was the divergence between the MOVE Index and the VIX, which gave us an idea that some volatility could be coming in as well. We saw the MOVE Index rising while the VIX was moving lower. And essentially, if you don't know what the MOVE Index is essentially the VIX for the bonds market. We'll go ahead and take a look at it here. So this is the MOVE Index, and we also had the VIX on here. So what was happening was we had the MOVE Index here had continued to rise and this started all the way back in July with the MOVE Index rising here. The VIX continued to push lower, push lower. This is why we were expecting the VIX, the potential to see an explosion of volatility from the VIX, is which we're seeing now. We're really seeing that start to pick up. This is another thing that we've watched. This is why I talk about watching the consumer confidence numbers compared to the S&P. Here we have the S&P up here, and look at the extreme divergence with consumer confidence. And U.S. consumer confidence is still tracking down. It's not even recovering. We had a little bit of a bounce here, and then right back to the downside. So this is also in line with the idea of a top coming into the equities market, at least for the near term. Both of these things that we just showed, the extreme divergence between what we're seeing with consumer confidence and the equities index, the S&P index, as well as the MOVE Index diverging from the VIX, suggesting a pickup in implied volatility for the equities markets, which is a bearish factor as well. Okay, so those are our plans here for the week. We're basically looking to get on the long side of the US dollar after some pullback. We like it against the Aussie and the Euro, but there are also some other opportunities, we think, with other currency pairs as well. We obviously can't cover them all in this brief video. So thanks for watching, folks. Have a great trading week, and we will see you again next week. Don't forget to check out bankpips.com. We actually have a brand new course coming out, and we're doing it live. We're doing a virtual live course over the course of 3 weeks, and it's going to be absolutely awesome. We're even adding on 3 weeks of live trading in a live trading room after that to further reinforce the ideas that are taught in our institutional level course in the live market, and I'm hosting it all. So all right, yeah, again, thanks for watching. Have a great week, have a great trading week. Stay safe out there. Mind your risk management. It's the most important part of your trading business. Take care. Cheers.